Right now, somewhere in the world, a bank is lending out money it doesn't have. Not metaphorically. Not as an exaggeration. Literally. The money does not exist. And the entire global financial system depends on that happening. Every single day without stopping. If it stops, even briefly, you don't get a recession. You get a collapse. And here's the part that should unsettle you. This isn't a bug. It's not a flaw that slipped through. It's not something regulators are scrambling to fix. It's the design. And that design, the architecture underneath every mortgage, every savings account, every central bank, every dollar, euro, and yen on the planet was essentially invented by a group of Italian merchants in the 1300s who were, at the time, just trying to avoid getting robbed. Before we go back 700 years, let's stay in the present for a moment. In 2023, Silicon Valley Bank collapsed in 48 hours. Not because of fraud, not because of some exotic financial instrument, because depositors wanted their money back at the same time. That's it. That's the whole story. And that was enough to erase a 40-year-old institution, trigger a federal intervention, and send shockwaves through banking systems on 3 continents. Most people looked at that and thought something went wrong. What actually happened is that something went exactly as designed, and the design showed its teeth. Understanding why requires going back to the beginning. Not to 2008, not to the Federal Reserve Act of 1913 further, to Florence, to the Medici, to a problem that medieval merchants had that you would completely understand. If you've ever tried to carry a lot of cash through a bad neighborhood, the year is somewhere around 1350, you are a wool merchant in Florence, you've had a good season, you're carrying the equivalent of several years' wages in coin through roads that are monitored loosely, policed basically not at all, and populated by people who know exactly what merchants look like and what they're carrying. Getting robbed isn't a risk, it's a scheduling question. So the merchants of northern Italy came up with a solution. They started depositing their coins with goldsmiths and money changers, people who already had vaults, already had guards, already had the infrastructure for keeping metal safe. You deposit your gold, you get a paper receipt. When you arrive in Venice, you hand that paper to a partner goldsmith, and he gives you your gold back, minus a small fee. Simple, elegant, it worked. Now here's where it gets interesting. The goldsmiths started to notice something. Most of the time, most of the gold just sat there. People deposited it. They traveled. They traded using the paper receipts instead of the actual coins. The coins themselves rarely moved. On any given day, maybe 10% of depositors wanted their actual gold back, which meant 90% of the vault was just sitting there, doing nothing, earning nothing. And a goldsmith, being a goldsmith, looked at that idle gold and had a very human thought. What if I lent some of it out? This is the moment. This is where the modern banking system was born. Not in a boardroom, not in a parliamentary session, not in a formal decree. In the quiet calculation of a medieval Italian merchant who realized he was sitting on an opportunity. He lends out 60% of the deposits, charges interest, keeps 40% in the vault for the people who actually come to collect. And it works. Because again, most people don't come to collect at the same time. He makes money. He lends more. Other goldsmiths see what's happening. They start doing it too. What they had invented, without naming it, without theorizing it, without any particular intention of revolutionizing. Global finance was fractional. Reserve banking. The idea that a bank only needs to hold a fraction of its deposits in reserve and can lend out the rest. It sounds almost boring when you say it plainly. A fraction. A reserve. Fine. But watch what it actually does to money. Here is $100. Real money. A deposit. The bank keeps $10. It's reserve. It lends out $90. That $90 goes to a borrower. The borrower spends it. The person they pay deposits it in their bank. That bank keeps $9. Lends out $81. $81 gets deposited somewhere else. That bank keeps $8.10. Lends out $72.90. This goes on and on and on. By the end of this chain, that original $100 has become roughly $1,000 circulating in the economy. One deposit, 10 times the money. This is called the money multiplier, and it's not theoretical. It's not an approximation. It's what actually happens. Every time someone makes a deposit in the banking system you use right now, the Federal Reserve, the Bank of England, the European Central Bank, they don't directly control how much money exists. They control the reserve requirement. They adjust the interest rate. They nudge. The banks do the actual creating, which raises an uncomfortable question that economists have been arguing about for a century. Is that money real? One school of thought says, yes, of course it's real. You can spend it. You can invest it. It drives economic growth. The ability to create credit is what separates a modern economy from a barter system. It's how businesses expand, how mortgages get funded, how governments finance infrastructure. Without it, the economy would be roughly the size of the deposits that actually exist, which is a small fraction of what actually circulates. Progress would slow dramatically. Capital would be scarce. The world would be poorer. Another school of thought says the whole thing is a confidence trick at scale, not maliciously, not fraudulently, but structurally. Because here's what they mean. When your bank says you have $50,000 in your account, what they mean is if you and every other depositor came to collect at the same moment, we would not have $50,000 for everyone. We would have a fraction of that. Your balance is a promise. It's a liability on a spreadsheet. It depends entirely on most people not calling in that promise at the same time. And that dependency, that structural vulnerability, is 700 years old and has never been removed. History is not subtle about what happens when confidence breaks. 1930, the Great Depression is just beginning. A small bank in Nashville announces it's in trouble. Depositors panic. They rush to collect their money. The bank runs out. It fails. Word spreads to the next town. Depositors there panic. Another bank fails. This cascades across the United States. In 3 years, nearly 10,000 American banks fail. Not because all of them were badly managed. Because fear spreads faster than cash. Franklin Roosevelt closes every bank in the country for 4 days in 1933, just to stop the bleeding, to reset the panic. That's what a bank run actually is. It's not a financial event. It's a psychological one. A collective moment where enough people stop believing in the promise simultaneously. And the entire modern banking system, every innovation layered on top of the Italian goldsmiths' original improvisation, is at its core a system for managing that psychology. Deposit insurance exists to prevent panic. Central banks exist to act as lenders of last resort when panic starts anyway. Stress tests, reserve requirements, capital ratios, all of it, the whole regulatory apparatus, is downstream of that original structural fragility. You don't eliminate the risk. You manage the risk. You make the risk invisible, most of the time. Now layer on what the system looks like today. In 2020, the United States Federal Reserve reduced the reserve requirement to zero. Zero. American banks are technically no longer required to hold any fraction of deposits in reserve. This isn't as catastrophic as it sounds, because other capital requirements still constrain how aggressively banks lend, but it is a remarkable thing to notice. The fraction in fractional reserve banking is now, in the world's largest economy, optional. Meanwhile, central banks have spent the last 15 years in an experiment that the original Florentine goldsmiths could not have imagined. Quantitative easing, where central banks create money digitally and use it to purchase government bonds and other assets, almost expanded the balance sheet of the Federal Reserve from roughly $900 billion in 2008 to nearly $9 trillion at its peak in 2022. Not borrowed, not taxed, created, typed into existence. This is the system operating at its logical extreme. The fractional reserve principle, scaled to the sovereign level, backed not by gold, not by any physical reserve, but by institutional credibility and the legal requirement that you pay your taxes in dollars. The whole thing works because enough people, enough of the time, believe it works. That is not a cynical statement. That is the literal mechanism. Here is the irony that should sit with you. The Italian goldsmiths who invented this system were eventually condemned for it. The church called lending at interest usury. It was a sin. The whole enterprise of making money from money was considered morally corrupt, and yet what they built became the engine of the Renaissance. The Medici Bank financed art, architecture, and political power across Europe. The credit system they pioneered allowed trade to expand beyond what physical coin could support. It fueled exploration, colonization, industrialization. The thing the church condemned is the reason the world you live in exists as it does, which suggests something worth sitting with, the most consequential. Systems are rarely the ones that arrived with official endorsement. They're the ones that quietly solved a problem, scaled past anyone's expectation, and became too embedded to question. Fractional reserve banking was never voted on. No parliament debated it. No philosopher designed it from first principles. It emerged from self-interest, scaled through imitation, and calcified into infrastructure. You couldn't remove it now even if you wanted to. Not without dismantling the credit markets. Not without collapsing the mortgage system. Not without triggering exactly the kind of cascading panic that the whole edifice was built to prevent. So where does that leave us? The system has survived every major crisis for 7 centuries. The Great Depression, 2 world wars, the 2008 financial collapse, COVID. It survived SVB. It'll probably survive the next shock and the one after that, because the institutions built around it have become very good at managing the moments when confidence wavers. But there is a question that the economists, the central bankers, and the people running the system quietly argue about in papers that most people never read. How much of this is resilience, and how much of it is the accumulated postponement of something that was always structurally fragile? The medieval goldsmiths were solving a problem. They weren't building civilization. They were just trying to avoid getting robbed on the road to Venice. And 700 years later, their improvisation is the load-bearing wall of the global economy. Maybe that's reassuring. Maybe it says something profound about human adaptability, about how systems built from self-interest can, despite everything, hold together. Or maybe the fact that it's held together for 7 centuries is precisely what makes the next fracture so hard to see coming. No one knows. Not really. That's the part they don't tell you in the textbooks.